From New York City for our viewers worldwide, I'm Dani Burger in for Jonathan Farrow. It is a Teflon market. Hot-ish CPI readings initially creates losses that quickly reverses into gains for both the bond and stock market. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up, U.S. CPI comes in hotter than expected. That fuels volatility and price action across markets as investors digest the fallout for the Fed. And that's where we begin with the big issue, inflation in America.
The big picture here is it's kind of like when you take cookies out of the oven. They're cooling, but they seem to be cooling really slowly. And you want that inflation rate to come down faster. And it is coming down. But it's going to take some time, and that's okay.
Cookies and all, Bloomberg's Michael McKee joins us now to break down the latest CPI results. So, Mike, a little bit hotter.
I like David's analogy there of the cookies coming out of the oven, because maybe it's warmer inflation than we anticipated. We do see a hotter number come in terms of the month over month for the headline, 0.4%. Changes the year-over-year number to 3.2%, first increase in a little while. CPI core up 0.4 as well, same as last month, but on a base effects measure, the CPI drops by 0.1% during the month. Now, what caused this? It's pretty much kind of what we have been seeing. It's goods prices deflating. It is service prices continuing to increase, and you can see there the blue is goods prices. They're not the problem right now. The Fed has been watching services. At least, as you can see, we did get a smaller rise in services than we anticipated, which is good news. And what did move? Well, car insurance was one of the bigger things that moved, and that's one of the things that has been going up on a regular basis that the Fed doesn't seem to be able to do anything about. Gasoline prices were up 3.8%. Airfares, 2.8% on a year, or 3.6% rather, on a year-over-year basis. They were up 1.4% on a month-over-month, and used cars were up 0.5%. We had not seen that in a while. Used cars had been going down in price. It says airfares, but that's used cars there. Then we look at the owner's equivalent rent and the rent of shelter. This is where the big problem was last month. We saw rent of shelter much lower than owner's equivalent rent. They've kind of come back together now, so less of an issue for the Fed going forward. Where does this all leave the Fed? Well, they've been looking, as you've no doubt heard in many of their speeches, at three different kind of buckets. One is goods prices, and you can see they have deflated. Then we look at services ex housing, which is super core, and it's much more elevated. That's the white line up there, and that did come down last month, but it is still more elevated than services overall. So at this point, it looks like the Fed doesn't have to move anything around for the March meeting, but this doesn't tell us a whole lot about what's going to happen after that.
Mike, definitely the most troubling is girls' apparel going up 6.8% on the month for the biggest increase ever. I think for the parents of daughters out there, the Fed maybe needs to be hiking. I don't know.
Well, they've been shopping at Claire's, I guess. One interesting thing that came up earlier on the show was that GLP-1, everybody's talking about the weight loss drugs, Wegovy, et cetera. Prescription drugs overall fell 0.1%. That would be good news. The bad news is tax preparation up 2.7%. So you'll pay more to file your taxes this year.
Well, it can't all be good, can it? Mike, thank you so much. Bloomberg's Mike McKee. Let's continue the conversation. Joining us now, I'm pleased to say, is Schwab's Kathy Jones and Zach Griffiths of CreditSights. Kathy, let me kick it off with you. 0.4% instead of 0.3% for the core month over month. Should this and will this shift the tone at next week's FOMC?
No, I don't think it changes anything for the Fed, which was already on hold for the time being until they get more confidence that inflation's coming down. And This is not a number that's going to increase their confidence. I don't think it changes those who believe that second half of the year is the time to start cutting rates. I don't think it's that meaningful, but it doesn't build confidence for the Fed. Even when you break down the component parts and you say, well, it was this, it was that, maybe that's not sustainable over time. I do think the direction of inflation is still down, but it really doesn't give the Fed ammunition or confidence to cut rates at the next meeting.
Zach?
I agree with Kathy. I don't think they're going to cut at the next meeting. And if you were looking for a major downside surprise to bring that on the table, we certainly didn't get it. I think on the core services side, we certainly have some encouraging signs with shelter costs coming down, at least off the peak levels that we saw last month. And I think you're starting to see a trend of a reversal in some of the reacceleration in inflation concerns that we got in data released throughout February. And so if you look at the ISM prices paid component of the services index and the non-farm payrolls, if you take that together with this, I do think things are moving in the right direction in terms of prices, and some of the concerns and more hawkish pricing that we got throughout February is likely to be reduced going forward.
Well, it is very clear that this market has not interpreted in a hawkish manner. Stocks are basically where they were before the inflation print was out, after some movement in between. Bonds at the moment, yields are slightly higher, but after dropping, waffling back and forth, it is maybe a market that is confused and trying to grasp for the narrative. But Kathy, at the end of the day, we have a second consecutive month of 0.4%. To some degree, are you not surprised that that's not causing more of a sell-off at this moment?
I think initially we got a pretty good sell-off because that was a bit of a surprise on the core number. Then you look at the rounding that went into it to push it up there, and it was just a very slight miss. I also think that the market is looking through a lot of the data and saying, okay, does this really change the story on inflation? It may be leveling off in certain areas. Certainly the services side on CPI has been leveling off. It isn't declining the way it was. But we have a lot of other components, as Zach pointed out, that are still coming down. So I'm not too surprised the market's taking it in stride. We also know that the Fed doesn't watch this number as closely as it watches the PCE figures. So this is not probably a game changer for the market. If you thought the Fed was poised to cut, as they've told us sometime in the second half of the year, you probably still think that. We think that. On the other hand, if you believe that inflation is stubborn, but you've got your evidence today. So we've got both sides going, and the market's kind of stuck in between.
Yeah, a classic case of maybe choose your own adventure. Torsten Slok at Apollo has clearly chose his adventure, and that's no cuts so far this year. In reaction to the CPI report, he writes that inflation has started to move sideways and remains well above the Fed's 2% inflation target. This means the Fed will keep rates higher for longer. Zach, that is a little bit of a different view of both yours and Kathy. We're in agreement. The trend is right. So what are folks like Torsten Slok getting wrong when they say the data that's coming in, it is strong and it means no cuts for this year?
Well, I think that he has to have the view that inflation is indeed flatlining from where we are today. And if that's the case, then sure, I think policy needs to remain tighter for longer. But our view is there are still disinflationary impulses in the pipeline, and we think it continues to come down. And so it really comes back to this idea of the Fed's real policy rate, taking the nominal policy rate that we all talk about and reducing it by a measure of inflation. If we use the core PCE deflator, we're at the tightest we've been at any point in the past 6 tightening cycles. And so when we think about recalibrating policy based on the inflation progress we've gotten so far, we think you need to take it down at a measured pace. And so that really all comes down to our inflation call, which we think continues to move lower, and still see plenty of signs in this report that that is a plausible outcome. But if inflation were to remain more sticky, especially in some of these shelter components that make up such a large aspect of the core CPI measure, core PCE measure as well, then perhaps it's more likely that we have higher policy for longer and we get more concern about a potential hard landing driven by that hard policy for longer.
Well, to that point, Zach, Jamie Dimon has been talking that this market is too sanguine on the possibilities for a soft landing. He said the other day that the world is pricing in a soft landing at probably 70 to 80%. I think the chance of a soft landing in the next year or two is half that. The worst case would be stagflation. Zach, you say there's a risk for a hard landing. Are you about where Jamie Dimon is? That's saying maybe around 40% is the only chance we have of a soft landing?
I think it's probably a little bit higher than that. And when we think about the probable outcomes for this year and even into next year, we think stagflation is less of a likely outcome than a hard landing just because of all the progress that we've gotten on inflation so far. And so I think the Fed has an opportunity to start normalizing the policy rate gradually and perhaps could engineer that soft landing. But if they were to keep policy too high for too long while we still have disinflation coming through in the next several prints, then I think that really increases that hard landing scenario. And so that's kind of how we're probability weighting our outcomes. We still think that the backdrop we have right now is constructive for corporate credit, but we're keeping an eye on what Fed policymakers indicate. So far, I think they want to cut, and we expect to see that in the May or June timeframe.
Kathy, how does your view line up with Mr. Dimon's?
Well, I think he's a little pessimistic about the economy and about the effects of Fed policy. So I wouldn't put a soft landing at 40%. I'd put it above 50%. I mean, when you look around, we still have a good labor market, pulling people in off the sidelines, which means there's enough demand for labor to keep the economy going well. On the other hand, we're not seeing wages push up as rapidly as we did earlier when we had a real shortage of labor. So I think the labor market is normalizing. And normalizing means that, yeah, you have job growth and you have some wage growth, but it's not so hot that it's pushing up the demand side of the economy relative to supply. So I'd be more optimistic than Jamie Dimon and say I think the soft landing scenario is definitely, a plausible outcome here. It's what we're achieving right now. But I would also agree with Zach that they can't keep rates at these levels, real rates at these levels forever, and get a soft landing. At some point, we should see real rates come down.
I will say this market, as it's been digesting through some of the CPI numbers, we do have yields at the highs of the session. 3 basis points is how much we've moved higher. We're at 4.13% on the 10-year yield. Kathy, Zach, you're going to stick with us. Kathy Jones and Zach Griffiths there. But first, let's take a look at some of the stocks that are moving ahead of the opening bell. With that is Abigail Doolittle. Hey, Abby.
Hey, Dani. Well, on that warmer than expected CPI print, we have futures bouncing around a bit. But beneath that surface, Oracle has been steadily higher. In fact, heading towards its best day of 2021 if these gains hold. This, of course, as their cloud revenue growth of 25% is seen as good news. It drove bookings higher. And some analysts are also saying that they like an AI tailwind, too, that they see evidence of that. On holding, down 14%. Sportswear company, disappointing quarter. Southwest Airlines, look at this, Dani. This is really interesting. Down 8.4%. They are reevaluating their fiscal year guidance on Boeing challenges. Apparently, they won't be able to get as many planes as they had planned. They are cutting the view on how many planes they can get in the air. And when they report their first quarter, that's when they'll actually update numbers, too. Investors seem a little bit skittish about that.
Abby, thank you very much. Abigail Doolittle there. Coming up, as people in the U.S. are clamoring for rate cuts, the BOJ is on a different path.
The BOJ can get very important information to decide monetary policy on Friday this week. That was the result of that spring wage round. That could be a catalyst. That could justify that BOJ to move next week.
We preview the week to come for the BOJ next. This is Bloomberg.
I think that the financial market expect a 50%, but I think that the probability could be higher than the consensus. Because that, as you mentioned, that the BOJ can get very important information to decide monetary policy on Friday this week. That was the result of that spring wage round. That could be a catalyst. That could justify that BOJ to move next week.
Bank of Japan officials are moving closer to raising rates. Bloomberg reporting that a final decision will be made after they see the tally from the spring wage talks that come out on Friday. Joining us now is Bloomberg's Enda Curran. So, Enda, where are we at this moment? Does it seem like essentially a coin flip that they normalize policy?
It really does, Dani. It sounds like it's a very close decision. Our colleagues in Tokyo reporting, as you mentioned, is that it sounds like they're 50-50 at best on this. Now, there are a couple of things at play here. First of all, there will be the trade union wage negotiations with those results due on Friday. And by all accounts, it sounds like if that comes in, say, on the higher end of the pay scale, then the BOJ will be green-lighted to move ahead. That seems to be the signalling. And then, of course, the question becomes, what do they do? Do they, pull out of the negative rate and bring it back to zero, or do they push it higher up to maybe actually increase it up to 0.1, go in kind of a one move and done type scenario? And also, of course, what do they do with yield curve control? So even if we'll say the wage data comes in on Friday, there are question marks over what exactly policy levers they will pull. And of course, if the wage data doesn't come in on the hot side of things, well, it probably will put the focus back on April, because either way, most analysts watching this story are saying that Japan is edging towards its first interest rate hike since 2007.
Even so, we did hear from Ueda, who said that there's still some weakness in some household spending data. That in itself seemed to weaken the yen this morning. It is weaker by about 0.5% versus the dollar. And I mean, that kind of language, it still seems like a tepid BOJ.
No, absolutely right, Dani. And I think we know with the BOJ, they always want to move somewhat cautiously. They certainly won't want to be seen to create a policy error. Remember, the BOJ in the past has raised rates at times, only, of course, to have to reverse gear on that. On the fiscal side of things in Japan, remember the famous move to increase the sales tax a few years ago that ultimately was blamed for kind of putting a stop in the Abenomics momentum. So the BOJ will be very careful. But nonetheless, though, people watching this story closely have been making the point that the BOJ are keen to at least get out of negative territory, to pull out of it. They're the last major central bank in the world pursuing negative interest rates. That is having a skewed effect on their markets. They are keen to get out of it. They're just looking for an excuse when to do so. And, of course, they want to pull off the magic trick, which is, of course, doing that without blowing up the markets and without setting back the economy. That's why it is a pretty tricky task for them. And that's why there's so much focus on the wage data on Friday. If the wages come in hot, then that would give them pretty good cover and a green light to say that they have to pull out of where they are.
I think that's the magic trick every central banker wants to pull off. Fix things, don't blow up the market. Enda, thank you so much. Bloomberg's Enda Curran, Kathy Jones, and Zachary Griffiths are back with us. Zach, does the BOJ need to move now? Is this their window of opportunity before we get Fed cuts, as you and Kathy say, in the second half of this year?
I think it is the BOJ's opportunity. You've had inflation come up quite a bit and had global inflation at really elevated levels over the past couple of years. So we are expecting the BOJ to move this year. And when we think about it from our perspective, it's important from a hedging cost perspective and how attractive U.S. assets become to Japanese investors. But we do think that the time is now for the Bank of Japan.
See, this I find interesting, Kathy, because if the BOJ moves, we're talking about a 10 basis point hike. In terms of yield differentials, it's not that big of a difference. So what impact does signaling have in this case if we are moving towards policy normalization in the BOJ?
Well, the difficulty for the BOJ is if they raise rates by 10 basis points, will the market actually believe they'll raise them by another 10 basis points and another and another and another? Or is this sort of the one-off move that goes so slowly that it doesn't make a huge amount of difference? And I do agree with Zach that they're likely to take this window of opportunity to get out of negative territory. But is it meaningful enough to change the trajectory of the markets globally? And I have my questions about that simply because it is a pretty small incremental move. It will matter to U.S. assets because of the hedging costs, but overall, is the magnitude of the move going to be so big that it changes the global bond structure? I think not.
I got to go back to what U.S. yields are doing right now, because as we've been speaking, we have seen losses start to mount slight, but losses start to mount across the curve. We're higher by about 4 basis points. Zach, when I was saying there's no reaction in markets, you said, yeah, that's about right. Now that we are seeing more selling, is this a dip that you'd want to buy today?
I think that the move that we're seeing now is more commensurate with what we'd expect, even with a modest upside surprise without parsing through all the details. And so I'd be waiting to see what happens with this 10-year auction this afternoon. If you go back to the refunding auctions that we got in February, it looks like end user demand for duration at right around these yield levels is still strong. In terms of buying ahead of that auction, I'd probably be on the waiting side. You have a 30-year auction tomorrow. So in terms of getting a gauge of the demand for duration at these yield levels, especially following at least a slightly hotter than expected CPI print, I might be in wait and see mode for now.
39 billion of 10-year today, 22 billion of 30-year tomorrow. Kathy, are we back to being worried about bond auctions?
Well, we always have a component of the market that worries about bond auctions, but when I run correlations and I look at the relationship between yield and the size of the auctions and the timing of the auctions, you don't see a huge correlation. So every auction has its story around it. But I think, we could back up a little bit going into this because we got the hot CPI report. But overall, I don't see the market tremendously worried about the auctions or the size of issuance, partly because demand is so strong. We were yield starved for 15 years in this market. And what we find is at 4.5 on the Treasury and certainly 5% in the corporate market, you have tremendous demand coming in to meet that supply. So I guess we can worry about it, but I don't think it's a long-term meaningful problem for this market to absorb the supply.
It's probably better for our health not to be so worried about it, Kathy, so I think that's a healthy attitude. Zach, Kathy has a point. It's not just sovereign bond markets. It's this corporate bond market, a record issuance this year. Demand easily absorbs all of that. Can we continue at that type of pace?
That's a great question, Dani. It seems like demand has almost been insatiable. When we look at some primary market statistics, we have seen some easing, at least in terms of how these deals are getting done on the corporate side. But when we think about where we're heading from here, the conversations that we're having with clients right now our spreads are tight, but yields are still attractive, as Kathy mentioned. And the question we're getting more often than what will make spreads widen is how tight can we go from here? And so we went back and did some work on that. You could see the investment grade market retesting the tights of 86 basis points of a couple years ago. And the high yield market could even move another 100 basis points tighter to match what we've seen in terms of recent history. That's not our base case, but really that's what investors are focused on as they're more concerned about not or losing the opportunity to snap up yields at these elevated levels versus worrying about spreads widening meaningfully from these levels.
More room to rally. Kathy, Zach, appreciate your time this morning. Schwab's Kathy Jones and Zach Griffiths of CreditSights. Now, coming up, we're going to get your morning calls, and later we'll be speaking to Luke Kawa of UBS. We'll talk about his outlook for these markets in a post-hot-ish CPI world. That converse still ahead. This is Bloomberg. Let's get your morning calls. First up, Jefferies upgrading Carvana to hold. It points to recent expansion efforts. Next up, JP Morgan upgrades Dollar General to neutral. They expect upside results to send shares higher. Finally, William Blair upgrading Oracle to outperform, seeing robust demand for AI products as shares soar nearly 10.5%. This is Bloomberg. Just seconds away until this market opens, and it is a market divided on what we think about the CPI report. Headline coming in at 0.3, but core coming in at 0.4, hotter than expected. The expectation being 0.3 month over month. For the equity market, it is still the Teflon market. Up 0.5% for the NASDAQ, 0.4 when it comes to S&P. Russell 2000, maybe this reduces the chance of those 3 cuts this year. So small caps, for their part, disliking that. Now, the bond market is a different story. We started out with losses. Those flipped to gains, and then losses yet again. Your 10-year yield down, up higher by about 4 basis points. Torsten Slok says that this reinforces the idea that the Fed cannot cut anytime soon. Dollar stronger, Euro sinks is weaker by about 0.1%, while NYMEX crude at $77.84. Now, one stock to watch at the open, and perhaps the reason that the stock market is still strong this morning is Oracle. They had better than expected results, and that puts the shares on track for the best day of gains in 3 years. Bloomberg's Ed Ludlow joins us now from San Francisco with more. So, Ed, here we go. Oracle basically supporting the market today.
Yeah, it's interesting to see that overall top-line growth 7% matched estimates, but the street is going straight to the cloud business where top-line growth was 25%. The split within that's really interesting. Cloud revenue, $5.51 billion. When we talk about cloud revenue in Oracle's case, we are talking about data storage, but also compute power. And the tailwind that they see in that 25% top-line growth is an AI-related story, right? Oracle is trying to work in the domain of other hyperscalers like AWS, Microsoft Azure, and the Google Cloud Platform. The stock now up 10%. And within that split on cloud revenue, $1.8 billion coming from the compute side, $3.3 billion coming from applications. So there is some enthusiasm here. The one number that Oracle talks about is one that in the past we've been skeptical about, which is remaining performance obligation. In other words, that is a measure of the backlog of orders, not yet booked as revenue, but basically deals that are in the pipeline. And what they said is that that figure was $80 billion at the end of the February quarter. The estimate from the street was $59 billion. So we're extrapolating that out and saying, okay, Oracle has its cloud business sorted, its story is AI relevant, and clearly the reaction in the stock market is important. Would note that their software business performed okay, kind of in line with expectations. They have used M&A as a tool to diversify their software offering, but each time they bought a data or software company, they then have to onboard them to Oracle's own cloud, which was a process completed in the quarter just gone. Stock up 9.5%.
Not too shabby. Ed, thank you very much. Bloomberg's Ed Ludlow. All right, let's turn to airlines now. Southwest is planning to reduce its capacity, and part of that, the large part of it, has to do with continuing headwinds from Boeing. Meanwhile, Delta shares, they're also under pressure. They did reaffirm its annual EPS forecast. Bloomberg's Abigail Doolittle joins us now for more. Not such a sunny day for those airlines, Abby.
No, it certainly is not. And for Southwest Airlines, we may be looking at the worst day going back to either March or June of 2020. So investors really not liking this idea that the Boeing mishaps and production issues are hitting Southwest. Now, essentially what they did cut are they were told that the number of planes that they will receive from Boeing is going to be 46 versus 79 of those 737 MAXs on a year-over-year basis. And as a result, they have cut, as you said, their capacity, the number of planes that they can put up into the air. They are not saying how much this will affect their numbers. They will update the financials on the first quarter, but that's a pretty significant year-over-year change. So some investors, analysts probably flowing that through their models. They're also putting capital spending on hold, and they are not hiring for now. So investors really not liking this. Again, that stock heading to its worst day since 2020. Delta Airlines, on the other hand, is a little bit more hopeful. They're saying corporate travel is returning because something else that Southwest did, one measure of revenue per seat, they cut that guidance as well, talking about the idea that demand is a little bit soft. But Delta's saying that corporate travel is returning and that they've actually had 9 of the top 10 sales days in their history, all within the last 10 weeks. They have, as you mentioned, reaffirmed the guide, but investors not liking it, although maybe there we have a little bit of green for Delta.
There you go, right as we're talking. Abby, thank you so much. Bloomberg's Abigail Doolittle. Okay, another stock we are watching this morning is Archer Daniels Midland. ADM revised 3 years of internal sales after an internal investigation found errors. Joining us with more is Bloomberg's Isabel Lee. Hey, Isabel.
Hey, Dani. So shares are up. Investors are reacting to the company's report that the fourth quarter sales were better than feared. And of course, the revised inter-segment sales for the last 3 years following an internal probe, as you said. So more on this. AMD disclosed $137 million impairment charge related to its animal unit. So operating profits and intersegment revenues at its nutrition business were adjusted down by tens of millions of dollars in 2021, 2022, and 2023. And ADM has put in place a plan to remediate some of these changes. And the adjustments in charge gives investors really a magnitude of how much this scandal has cost. It wiped out around $7 billion in the stock at the first announcement, and now investors are reacting to positive news on this. So Citi said results were more or less expected. Barclays said that the outlook was achievable, and Vital Knowledge said the news could have been worse. So in January, recall that ADM surprised Wall Street when it replaced its CEO and suspended him following accounting practices. So the SEC was the one who requested for the information, and ADM confirmed in its annual filing that various adjustments didn't really impact earnings at all. And more on the earnings, adjusted EPS fell in the range of $5.25 to $6.25 per share. That's down around 18%, going to the midpoint range. Shares are down around 20% year to date, but today is a good day, up around 5%, Dani.
Isabel, appreciate it. Bloomberg's Isabel Lee there. All right, let's stick with earnings. Kohl's blew EPS estimates out of the water this morning. They had strong sales thanks to Sephora. For more, we're joined by Bloomberg's Katie Greifeld. Katie, this is basically what every retailer wants. They want a Sephora in their portfolio.
Absolutely, especially with Sephora going viral on TikTok. That's another story, though. Let's get into the specifics here, because you're right. We did see some good news on EPS. Specifically, adjusted EPS came in at $1.67 in the fourth quarter. That was versus estimates of $1.29. But it was that miss on same-store sales that's really weighing on the stock this morning, as you can see there. Same-store sales in the fourth quarter, they fell by 4.3%. And that is an improvement over the previous quarter's decline of 5.5%, but it does mark an 8th straight quarter of declining comp sales. And this is a particularly painful miss, given that the fourth quarter obviously covers that all-important holiday shopping season. Kohl's also gave what Citi is calling an uninspiring guide on operating margin. Bloomberg Intelligence, though, with a bright spot, noting that a new partnership with Babies R Us and also those double-digit revenue increases at Sephora, they may push Kohl's to actually exceed its annual comp sales guidance. So it's a bit of a mixed bag, Dani, and you can see that in the stock, really wiggling between gains and losses right now.
Katie, thanks so much. Bloomberg's Katie Greifeld. Okay, let's turn back to these markets, because we've had that CPI figure out for about an hour now. Luke Kawa of UBS Asset Management Asset Allocation Strategist, writing, quote, data so far this year have forced a resetting of expectations in which both the start date for the easing cycle for developed market central banks is being pushed back and its depth reduced. We believe the path of least resistance is for this trend to continue. Joining us now is Luke. So, Luke, we have the numbers a little bit hotter when it comes to core. Is this that trend confirmed? We push back the timing and the depth of cuts?
Oh, well, possibly. I do think that that's the bad news part of it. The good news is the reason why. It's not just the stickiness of inflation. If anything, I would say that the more proximate cause for why we've been able to price out so much in terms of interest rate cuts this year has been the strength of growth, the resilience of growth, particularly led by the U.S., but also signs of that broadening out. And what that does mean is that even as we perhaps price out cuts a little more, that's not too disruptive to the equity market. Again, worrying about a world in which we're talking about 2 versus 3 cuts is a lot better than the world when we're thinking about 6 versus 9 cuts because of the possibility that economic activity just decelerates so much.
Yeah, that is a really good way of putting it. Yet we split our hair over 3 versus 2 cuts, Luke. So are we about to live in a world then where growth doesn't necessarily perpetuate inflation? Because if you listen to someone like Jamie Dimon, he says we're underpricing the risk of a stagflation. So can we look through the concern that growth equals sticky inflation?
Well, I would say look at what happened the second half of 2023. You had growth that would be, considered in real terms well above trend, well above normal, and you had this during a period of surprisingly strong disinflation. So that was a time obviously when supply was continuing to catch up with demand, and so you didn't have any kind of constraints on price pressures. Probably that low-hanging fruit is going to be a little bit less hard to come by. So one thing we do think that is going to be in play is that the dark side to this recovery, this nascent recovery we're seeing in global manufacturing, is that the strong support you've gotten from outright deflation in goods just isn't going to help as much in central banks getting aggregate inflation to target. What we've seen year to date in terms of the couple inflation readings we've got is a lot of stickiness in core services. I think that's something that Fed officials have highlighted as something that's concerned them in the past. Powell's talked more recently about how he's more concerned with aggregates again. But again, in our view, you are getting a gentle cooling, a slow slowdown in the U.S. And if you are just looking at the labor market data right now, you would see gentle cooling. You wouldn't see something that gives cause to suggest that core services is really going to accelerate and get out of hand. But it isn't necessarily something that says core services should be at something consistent with a 2% inflation outlook.
Right. And in that sort of global upswing, you also talk about this idea that, yes, U.S. exceptionalism, but also look elsewhere. You talk about Japan and Europe. Japanese markets have certainly reflected that. But can you just tell me your bullish case for Europe? Because I think a lot of people have been disappointed about European data over the past many years.
for many years, but also, again, we now have Europe surprising low expectations. When you disappoint for so long, that's the good thing, that eventually it doesn't take much to surprise to the upside. One thing that we've noted is right now, typically, growth revisions are typically very, very highly correlated between regions. Since the middle of 2023, there's only one region that's had growth revised to the upside. It's the U.S. Everything else is completely flat. In our view, that is not something that is consistent with a global manufacturing rebound that we're starting to see. So the chief beneficiary of this, on a relative basis, should be Europe. You should be starting to see those growth revisions between the U.S. and Europe narrow. And with, as you say, the bar so low and people so scarred by perhaps a history of being disappointed in Europe, this is a place where there are cheap markets and the potential for earnings catch up, and a central bank that I would say certainly isn't going to foist a lot of currency strength that hurts their exporters.
So what would you be buying in Europe? Because at the moment the trade seems, I don't know, Novo Nordisk, maybe some luxury. Are you looking more towards cyclicals then?
So as a general matter, that's kind of our view. We're top down, so not doing anything company specific. And the reason for Europe and the reason for Japan, it's about playing offense over defense here. It's the view that your Europes and your Japans that are more levered to a nominal growth environment that's going to be a lot better than we got last cycle. Those are what works, and what works less in that environment are more defensive markets. Give me Switzerland or the UK on the other side.
All right, Luke, stay with us. Luke Kawa of UBS. Now, coming up on the show, the TikTok bill is picking up speed in Congress.
I just want to see TikTok survive and thrive, but under American protections, in American hands.
We're going to have the latest on that legislation next. This is Bloomberg.
I think that we don't need the Chinese Communist Party telling our kids what to watch online, which is essentially what's going on here. And I just want to see TikTok survive and thrive, but under American protections, in American hands. And everyone, I think, here in America should want that too.
That was Democratic Congressman Seth Moulton of Massachusetts speaking on Bloomberg yesterday. A bipartisan bill that would force TikTok's parent company to sell the platform or face a ban is gaining momentum in Congress. Officials are set to brief House members on the bill today and then vote tomorrow. Bloomberg's Anne-Marie Hordern and Ed Ludlow join us with the latest. Anne-Marie, we talked about this yesterday, and it does seem like even since then, over the past 24 hours, it's picking up speed.
It absolutely has. We heard from Steve Scalise, the #2 Republican, when asked about, will this have the votes to pass? He said, yes, it will. And remember, he is a Republican. We have to remember, this is very political in one sense, but also then there's the national security concerns that we've heard a lot about overnight. So one to the politics. We saw former President Donald Trump put a little bit of cold water on the banning of it. He talks about that this would make Facebook bigger. And also there's a lot of reporting that he wants the Club for Growth to donate to them. One of those big billionaires is Jeff Yass, who has a more than $30 billion stake in TikTok. Former President Donald Trump recently called him fantastic, looking to potentially shore up some of those campaign donations from some of these individuals. Then, of course, on the Democratic side, you have the Biden administration, with Biden saying he would sign this law if it was to pass through the Senate and the House, yet the campaign is still using TikTok. So a little bit of hypocrisy on both sides. Then there's the national security threats, Danny. And I want to bring you to what we heard from the Office of the National Intelligence yesterday. And they had their annual threat report out, and they mentioned TikTok. They say an accounts run by a PRC propaganda arm reportedly target candidates from both political parties during the U.S. midterm election cycle in 2022. So there's politics that are complicating this, but then when it comes to national security, it's really hard for some of these politicians to not vote yes on this bill.
Well, okay, let's say we get a vote yes on this bill and TikTok needs to be divested. Ed, who would buy it?
Fantastic question. I mean, the answer in the first instance is probably not Oracle. AMH and I were chatting last night, and, TikTok does not come up on Oracle's earnings calls, because even though Oracle is basically housing the data for US users through its data centers and capacity in this country, they made it very clear that back in 2020, they are not going to be talking about that on earnings calls, but I bring it up because Oracle's also incredibly laden with debt. So it seems financially unlikely. There have been reports this week that Bobby Kotick, the former Activision Blizzard CEO, is considering a bid, though the economics of that aren't entirely clear. It's going to be a really interesting week and a really interesting passage of the bill. You know, TikTok spent $10 million almost in lobbying. That doesn't seem to have been that helpful. And then you have everyone weighing in. You know, the Trump argument is that if TikTok is banned in the United States, there are 170 million TikTok users in the US approximately. He sees Mark Zuckerberg and Meta benefiting from that, which he sees as a bad thing. And you will have noticed that Elon Musk, the owner of X, formerly known as Twitter, has taken to that platform in the last 30 minutes to say that this has nothing to do with foreign ownership, because among the issues listed in the bill, foreign ownership is not the sole one. There are many others, and he sees this as a form of government censorship. So it's going to be interesting, but I commend you on raising the question, because for me, that is the question. If the bill passes, who buys it? And I think it's as simple as that.
Yeah, and the direct Trump quote was, young kids on TikTok would go crazy without it. Hard to dispute that that would also be a net outcome. Anne-Marie, Ed, thank you very much for that. All right, let's turn back to broader tech. Luke Kawa of UBS is still with us. Luke, I mean, we can debate until the cows come home about whether tech is in a bubble or not. But Savita Subramanian over at Bank of America, I want to quickly read you what she said about a full bubble for this market. She says that sentiment is neutral. Despite pushback, we hear that sentiment is full bull. Bull markets ends with euphoria, and today's euphoria has been ring-fenced to themes AI, GLP-1, etc. Would you agree with that, that we're not full bull, it's really just these very specific segments of the market?
I mean, I think that's very fair to say, and I think I've been pointed out ad nauseum, but a big difference between now and the mid-90s is the fact that, hey, what's happened to certain companies' PEs as they've boomed? They've gone down. It's been a story of fulfilling the earnings growth that's been priced in, and as investors, the half of the game is you go where the earnings growth is, expecting it to continue, or you go where you expect the earnings growth to be improving. That would be the improving side would be your Europe, but go where the earnings growth have been. That's Japan, especially the story of share shrinkage there, and that is also still U.S. tech in spades.
I have to say, it is really interesting that tech stocks in the wider market have been somewhat immune to higher rates. Today, rates are moving higher. This bond market's up by about 4 basis points, and gains that we saw in the stock market this morning are starting to peter out. You can see it on the screen. They're a little changed lower for the Russell 2000. Does that immunity to yields moving higher, Luke, does that change as we continue to push out the rate cut narrative?
Oh, I think that's certainly a possibility. However, you have to kind of go, what's the causation here? And why would we expect a certain segment to be underperforming as yields go up? For instance, if you think yields going up on a lot of strong growth, cyclicals are going to capture more of that growth and they're going to have better earnings than the rest of the market, well, that's a reason for tech to be underperforming on rates up. If we have what we have now, which is still seems to be a full boom in at least tech CapEx spending related to AI, well, then there is a certain immunity from higher rates there as long as you can post the earnings outperformance. So I think getting the causality right is very important rather than just assuming longer duration asset, therefore bad if rates up. I don't think it's that simple. I think it is a story of the earnings growth and the relative earnings growth. That for tech is not an interest rate story right now.
Yeah, and just the fortress balance sheets of them, the huge piles of cash they have protecting them and working for them when rates are higher. But Luke, when you look at what's hedged in this market, it is upside hedges. That seems to be what's in vogue at the moment. Is there some degree which maybe this is an overly complacent market?
I mean, on the one hand, there's upside hedges. On the other, Bloomberg's published, I think, some great stories on still a lot of new, effectively shortfall ETFs that do effectively collect a lot of assets along the way. Is the market overly complacent? I would say, not necessarily. The market is well pricing the increased likelihood, as it has over the past year plus, that recession is just getting less and less likely, right, even despite all the monetary tightening that had been brought to bear.
We're out of time, and I couldn't even ask you about Volmageddon and those short ETF, those short vol ETFs. Luke, thanks so much for joining. Really great to see you. Luke Kawa of UBS. This is Bloomberg. We got the hotter CPI report, 0.3% for core, 0.4%, 0.3% was what's expected. So here's what's up next. Today, presidential primaries take place in Mississippi, Georgia, and Washington. Then VW and Adidas report earnings on Wednesday. Then we get more data, U.S. PPI, retail sales, and another round of jobless claims come out on Thursday. And then we round out the week with you, Mitch. For now, it's yields higher by about 5 basis points after that hotter CPI. This is Bloomberg.